Okay, let's go over break even point. Okay, this is something that we talk about a lot with our customers and going over different options. So you're deciding between two interest rates. Now let's just get a rate quote. So you can go to sellfy.com, hit the view rates where this is a refinance. Let's say it's a rate and term. Let's say it's a 30-year fix. Let's say our home value is 999,000 by keeping it under a million. Then that enables the possibility of an appraisal waiver. Let's say the loan amount is 500,000. Let's say it's in California, San Francisco, and let's say it's excellent credit score, single family home, primary residence with no second mortgage, such as a home equity line of credit. So you hit view rates, and you're going to see options here from Quicken Loans. So let's take the first two options. So you see 2.25% 30-year fix, 2.375 30-year fix. Now, obviously, if you're just deciding between the two and not factoring in any costs, you're going to choose the 2.25% because that's the lowest rate, the lower rate. That gets you a lower payment. But the way that interest rates work is the lower the interest rate, the higher the cost, the higher the interest rate, the less the cost. So you can see how your credit changes depending on the rate that you select, all the way up to, let's say, 2.625. Now you're actually getting $4,400 lender credit. Well, the closing costs are usually around like $3,000 or so, and then maybe even less than that if the appraisal is waived. So this, including the appraisal fee, you're looking at total loan costs of around negative 1,300. And so that negative 1,300 can be applied towards your unpaid principal balance or towards your property taxes or prepaying interest. But I digress. Let's take the first two options. Now, 2.25, 2.375. Obviously, you want the lower of the two rates. But which one makes the most sense for you? Well, it depends on the break-even point. So here your loan costs are $9,201. Here your loan costs are $5,411. You can see it's a pretty big discrepancy in pricing between the loan costs. So we have 9201. Here, so 9201 minus 5411. So the difference in closing costs is $3,790. The difference in your monthly mortgage payment, so 3790, clear that. The difference in the monthly mortgage payment is 1911. Let's start this. 1943.26 minus 1911.23. It's $32.03. So the difference in the break-even point is, so 3790 is the difference in the closing costs, and it was divided by 32.03. So the number of months it takes to recoup that difference in closing costs is 118 months. So that equates to 9.86 years. So if you're considering the refinance, you want to think about how long you plan on owning this home, how long you plan on having this mortgage. The longer you have the mortgage, the more you benefit from having the lower interest rate. The shorter you have the mortgage, shorter you own the home, the more you're better off choosing the higher interest rate.